Hey guys, Young here. Today I'm going to share with you guys this new stock. Actually, it's really a new stock because it's an IPO stock that recently IPO, and it's Eagle Hospitality Trust. The IPO at 78 cents and now it's all the way at 46 cents. So it's actually almost a 40+% drop really. And a lot of people, I mean, in Singapore, it's a Singapore IPO, right? So a lot of people has been wondering, should you buy this stock? And that's why I'm posting this video. Buy the dip, Eagle Hospitality Trust. All right. So you can find this, this should be a ticker symbol. You can find it in your Singapore brokerages. Yeah, without further ado, because I got a lot to cover, let me just quickly go ahead. All right, so my mouse working? All right, so it's just my com lag. All right, so there's a few disclaimer. This is a 100% risky trade because there's no past financials for us to refer. It's a 100% a new IPO, just IPO in May. And suddenly it just plunged upon the news, and that's why you see this plunge in chart. You can see over here that is from 78 cents all the way down to 42 cents. And now I'm actually going to make a position in the next 72 hours because I see as a potential. Let me just break it down for you later on. And full disclaimer down here, please only invest money you're comfortable with losing because of all the risk involved I just mentioned above. No past financials for us to refer. A new IPO always have a lot of risk, as Warren Buffett say. Stay away from IPOs, but I'm actually entering it because I see some potential in it. And yeah, these are some disclaimer whereby the presentation is only for educational purpose only. So yeah, do your own due diligence. All right. So Eagle Hospitality Trust is actually comprises of 18 hotels portfolio in United States, US, but it's actually an IPO in Singapore Stock Exchange. Right, its total valuation is $1.27 billion, and 17 out of 18 assets is freehold, meaning to say it's not on lease. Means the government can't actually take back the land. It's actually 100% theirs. All right, if they actually pay off all their debts, and eventually the land will be theirs. All right, nobody is going to take back. Unlike us in Singapore, they can actually take back from us after 99 years, potentially after 99 years. All right. So a few key points that it's in US at a large high growth market, which I'm going to talk to you guys about later, elaborate later. Its international brand consists of all the brands that you may have heard of already. It's well invested, and also they also actually identified growth in it. So let me just show you guys quickly. So the 18 portfolio actually across United States, you can see over here, consists of 9 upper scale hotels, 5 upscale hotels, 4 upper mid-scale hotels. So you can think of it kind of like a 3-star hotel over here, then a 4 to 5-star hotel, maybe 6-star and above. All right, so it's easier for us to understand. So it's total of 5,420 rooms among all of these 18 hotel portfolio, aggregated around $1.27 billion. Ignore this typo over here. So 94.7% of the portfolio are actually in the top largest metropolitan statistic area, meaning to say high population area where people actually there's a lot of tourists or there's a lot of traffic, inbound and outbound traffic that may actually potentially rent a room and stay with them for maybe 1 or 2 days or potentially a week on a vacation or something like that. All right. So their sponsors actually by Urban Commons LLC. So you can read up all these. You can pause this video down here, but because I'm on a tight schedule, there's a lot of things to cover. So you can either pause this video or you can just quickly summarize for you guys that the Urban Commons LLC actually have 10 years of track record with very, very strong hotel acquisitions and intensive asset management. If you actually go read, later I'll share with you guys the link, the reference link. If you guys go read their portfolio, their IPO prospects, you can see that the Urban Commons has been actually, been making deals with very, very reputable brands, and they're actually very, very experienced in that. In the case of even refurbishing hotels and refurbishing these tourism places, and then potentially make it a successful real estate investment trust investment. All right. So some of the key highlight for investments are like macro industrial. So they are saying that this is based on their IPO prospect. They are saying that there's actually strong macroeconomic drivers going on. So it's pushing tourism up. For example, the consumer spending, etc. The low unemployment rates, etc. So all these are actually very, very favorable for tourism and hospitality. There's a portfolio quality. whereby they actually invested in places where high metropolitan, I don't know how to pronounce that word, but high metropolitan areas, and they actually have a very, very good portfolio of brands. I'm going to show you guys later. Growth and stability and committed sponsors, which is actually mentioned above. All right. So these are actually the well-invested hotel. All of these are their names and everything. You can pause this video, take a quick search all over on Google. So that's what I did. I actually went to search, copy paste the name and search on Google, right? So all of them actually have 1,000+ Google rating, and that's on Google rating itself. You haven't considered like travel agencies like Agoda, Expedia, Bookings.com, etc., etc. So they all have at least 1,000+ of reviews, Google reviews. Some are good, some are bad as usual. Not all hotels perform very, very good, right? So all in all, it's still good lah. And we have actually diversified in 3 parts. They have the corporate part, they have the leisure part, and the airport part. So actually quite good. They're actually not so much of all on leisure part, but they also have a large chunk for the business part and leisure. Leisure actually have also, if I didn't see wrongly, there's also the water park, combination of water park with Holiday Inn. So you can see Holiday Inn is actually one of the brands that we already know. So I'm going to show you guys more later. So now this is actually, they actually have well invested primarily freehold international brands. So brands that actually linked up with them are companies like Marriott, Hilton, International Hotel Group, if I didn't remember wrongly, there's IAG, etc., etc., all of these hotels. And you can see the largest partnership is with Marriott Hotel. All right, and the next one is Hilton Hotel. And Hyatt is over here. Hyatt. There's also hotels that we are aware of in Singapore itself already. So the thing is that Marriott actually lowered their full year guidance. They actually foresee a flat to 2% worldwide growth in revenue, and then same for Hilton worldwide, also see a flat to maybe just 1% increase. So it kind of like contradict a little bit with what they say about high growth. All right, next point is that this is actually a chart by independent source based on their IPO prospect, right? They are independent researcher. They actually established that actually if there's no recession, if there's no recession in the country, in US specifically, because all of the portfolio in US, right? You can see that the performance of it is actually quite good. The growth is actually 2.7 on average per annum, and this 2.2%, now we are 1.4%. So right now, are we overdue for a recession? Now, if we are overdue for a recession, then that is a key point for it to come back down again. All right, so do take note of it. And we have favorable supply and demand, so we can see that currently there's actually a positive demand and supply for growth for lodging, and you can see that they project to the next 2020 that there's actually going to be even better even more demand and supply for it. And if they actually have independent market research consultant to find for us number of passengers in the US airports, so it's actually a growth. So you can see that tourism is there in US itself. It's just a matter of are people staying in their hotels. All right. They also have actually a very, very good, well-structured stability and for growth, lease for stability in lease and for growth. So this fixed rent accounts for 66.0% of their rental income. There's 71.3% variable rent based on gross operating revenue. And with the prudent capital structure, they actually have approximately 38% aggregate leverage with approximately 170 million debt headroom. So they actually, there's actually more ways to go. They can actually take on a little bit more debt. And with all of these debt maturing at 4 years time, 4.2 years time, which is 2024. All right, so the EHTs, which is Eagle Hospitality Trust, is actually all going to their REITs manager. The REITs manager is expected to enter into interest rate hedging instruments to mitigate risk volatility for at least 75% of their borrowing. So they're actually looking to reduce their risk exposure because of their leverage. And currently with the decreasing interest rate, I believe that they're able to actually potentially able to pay off all of their debts easily. All right, so this is what they actually posted in their prospect. Their occupancy rate, most importantly, is the occupancy rate has been actually increasing over the past few years, and they project an even higher growth into the next 2020 itself. So 2019 is actually looking to be better than 2020 itself. All right, this is a little bit suspicious, a little bit something to take note of. All right. So what happened is that they actually IPO with a price of 78 cents and they expect to give a 8.2% dividend yield, and after that projection for 2020 is 8.4% dividend yield based on this price, alright, based on this price. And recent news actually suggests that if you read the Business Times, etc., or the Age, they actually highlighting about this king called the Queen Mary, which is a ship that actually converted into a hotel. Now this ship is so run down that if you go Google it online, they can tell you that it's one of the worst hotel ever. All right, the worst hotel ever. So a lot of concerns start to come up because it's actually after all still a ship, right? So there's maintenance fee. There's a lot of maintenance fee going on with if you're just doing a hotel itself, not so bad. But if you're doing maintenance and repair on a hotel that is a ship, that's 2 times the risk out there in the market. And that's why it's actually flagged out by the Business Times, and a lot of news agencies start picking up on it, and they start to shoot this thing down, and they start to question it and shoot it down. And that's why the stock actually plunged all the way down to actually around 46 cents on last Friday's closing. All right, so if you do a quick Google on the Queen Mary, right, I can tell you it's actually very, very poor. It's one of the most embarrassing experience. They had no hot water in the entire boat. We are British. We went to visit our classic ocean liner. It was the state of the ship is so awful and unheated. So it's just very, very poor. All right, but people still go there for their iconic historical site and the maze, etc. So it's just the hotel, which the ship is actually a problem. I mean, but then again, that is their main business revenue, all right? So it's actually a huge problem, all right? It's actually a huge problem. So according to some financial sources that I actually got, right? So you actually estimate everything out with the Queen Mary, meaning to say if they still manage to keep the Queen Mary and do some basic maintenance, right? The dividend DPU, right, on 54 cents, now it's like IPO at 78 cents, right? Then when all the news article hit, that's where 64.5, and another news hit 54.5. So at 54.5 cents, which is the latest article that actually was posted, and this is why based on this price here, right, you actually get a 11.67% dividend yield, right? 11.67% dividend yield. And so what happens is this author actually have another calculation without the Queen Mary. This is an estimated analyzed figure. If they take off this thing completely off their books, right, they will actually have a dividend yield of potentially 9% only. And then if you look at the price to book ratio, it's actually 0.61. We're looking for 1, 0.77. So we're also looking for 1. So in both cases, it's actually undervalued already. All right. So you can also look at the net asset value. It's actually quite high. And actually, I mean, if you compare the net asset value and the total asset value, and you compare the debt, you can see that we are more than able to cover off the debts, all right? So, but a few things to take note of is also that large shareholders like Norbert Shin Hao Yuan actually sales of 5 million units at 0.675 at market of transaction after the IPO, which is around October. Then Tong Jin Chen also sales of 10 million units at 0.65 at market transaction. So they're suspecting that they actually already knew of this thing after the IPO. So they actually took the money, the IPO, as a way of escaping, get out of their capital, and then they run off already. All right. But then now at the current valuation of 0.46 cents, you can see that your current dividend yield is around 13.83%, and if the worst case scenario, it's around 10.67 cents. Now, if you give you a more margin of safety around there, you can still expect to collect around 7% dividend yield, around 7% dividend yield. Your price to book ratio will be 0.52 and 0.66. All right, so we also have a few things to take note of. High net margins on property, it's still there. Total debt to asset is still very, very low, and then we're still under 45%, which is the gearing ratio, which by law in Singapore law is actually still very, very good. All right. So in their distribution policy, they plan to distribute 100% of the distributed income in the 13 December 2019, and after which they distribute 90% of annual income, and then I believe that the other 10% will be used to fund off the debts. All right, so distribution made on a semi-annual basis, not 4 times per year, it's 2 times a year. And the distribution will be paid for listing to 31st December 2019. Then they'll be either paid on or paid before, this is still not too clear yet, by 30 March 2020. All right, so some good points is all of this. All right, I actually mentioned good points, good portfolio, everything here, bad points here. Here is what we plan to do. We plan to split our entry to around 4 times, buy once here, buy one time here, buy one time here, and buy a last time here. Alright, so I'm out of time, so thank you very much for tuning in and see you next time. Bye bye.